Hi friends, so today we are going to see about how we can derive the various profitability ratios and stability ratio by using the profit and loss statement of the company. So in the previous discussion, we have seen the various aspects within the profit and loss statement. What is composed within the revenue aspect, we have seen that. We have seen what is composed within the expense portion. And then after subtracting of the expense from the revenue, we then derive the various types of profit. That is the profit before tax and the profit after tax as well. Once we get the profit after tax, we then divide it by the total number of outstanding shares to derive the earning per share of the company. So now let us see the various types of profits which can be derived from the profit and loss statement apart from PBT and PAT, which we have already covered earlier. The aspect of profit is called as the gross profit of the company. So this is derived after subtracting the cost of raw material or cost of goods taken towards manufacturing of finished goods. The total cost is subtracted from the revenue. So this will give us the gross profit. From this gross profit, after deducting the selling, general and administration cost, and after also deducting the depreciation and amortization cost, and then subsequently also deducting the employee cost, we get the operating profit of the company. The operating profit is also called as the earning before interest and tax. Now from this earning before interest and tax, EBIT, if we deduct the interest part, we get what is called as the PBT of the company, profit before tax. Now from this profit before tax, if we deduct the tax, we get the profit after tax of the company. To the EBIT profit, we add back the depreciation and amortization expense to get the EBITDA, that is earning before interest, tax, depreciation and amortization. So now that we have understood the different types of profit, let us go into the profitability ratios. The first profitability ratio is the gross profit margin. So this we derive by taking the gross profit as we have just seen and divide it by the total revenue of the company. We know gross profit margin. Let us see how to derive the sg&a percentage margin of the company. That is selling, general and administration margin of the company. So this we just take the sg&a expense and we divide that by the total revenue of the company. Now that we know the sg&a, let us get into a third profitability ratio, that is the EBIT margin. So the EBIT margin is calculated by taking the EBIT divided by total revenues, you get the EBIT margin. Similarly, we do that for deriving the net profit margin. So net profit margin, you take the net profit and divide it by the total revenue. So these are the different types of margins which can be calculated using the profit and loss statement of the company. And you would read in various quarterly reports, various news, they talk about various types of profits. They talk about EBIT margin, sometimes they talk about EBITDA margin, sometimes they talk about gross profit margin. So now you won't be confused because you know the technicalities involved in the calculation of these respective ratios. So the stability ratio we will see as part of the balance sheet, and also the profitability ratios. A certain part of stability ratios we need to consider with respect to the balance sheet as well. So we'll see that next in our next video. So please subscribe so that you can continue watching my subsequent videos as well.